So you still have power. I mean, impressive presentation.
Thank you.
Sorry, I have to switch to English. It's the only language probably we can get across. First of all, thank you inviting me here, or have the opportunity really to speak here in Tel Aviv. It's my first time here, and it was a pleasure, or it's a pleasure actually to be here. Second, let's introduce myself before I come really to the economic outlook I want to present you, and probably some implications how you want to invest, or how you might invest then also in the future based on this outlook for the next 6 months, for the next 12 months. You see already here the company I work for, that's Julius Baer. For the people which are not familiar with Julius Baer is in Switzerland the third largest bank, and in contrast to the names probably you know, like UBS, Credit Suisse, Julius Baer, it's only in one business, and that's basically wealth management. This distinguishes actually Julius Baer from most of our competitors, in particularly on the global level. So the advantage, of course, for our clients is that we do wealth management, and we don't sell you products, we don't sell you anything you don't want, but we choose best of class. So this is the business case for Julius Baer. And of course, Julius Baer as a Swiss bank is globally active. It's quite large locations outside Switzerland in Asia, but also from the location I come from Frankfurt, and we have in Germany also quite big business, and not forget in Tel Aviv, we are expanding business here as well. This is just Julius Baer. Coming to myself, I said already, Julius Baer, just one business case. You might say a bit boring. We say in Switzerland, conservative. My CV is also similar like that. I started with Julius Baer 15 years ago. Since then, I started as a junior economist. I took the role then as a European economist in 2003, and finally took over then also the currency research, the heading of currency research in Julius Baer in 2007. I'm still responsible for the economic outlook, and that's why I want to spend also the major time really what is going in the economy, and in particular three themes which we think are important when we're looking at the outlook for the next 6 months, next 12 months, and which are important then also for asset allocation and for investment implications. The headline I choose is positive shocks in the making. And before coming to that, let me just give you a preview what we think in terms of economic outlook, and what I will present you probably in the next 20 minutes first in the economic outlook, what the major themes are. The first one is that we still live, and we think we still will live, in a world of relatively weak economic growth. I will come to that later. The second one is that something is changing, and that's the focus on emerging markets. Unfortunately, not a positive focus on emerging markets. We at Julius Baer think that the good things for emerging markets are more or less over. And it's a combination of political risks are rising, and some imbalances have built up in the good times. I come into more details on that. And then finally, what we think is important, and what drove actually the headline for our presentation, is really that when we look at developed economies, at the advanced economies, we see, very surprisingly for us, a number of supply-side reforms, a number of structural reforms. And as economists, we frame this as a positive supply shock. And this have very important implications, we think, on the inflation outlook, or better frame it, on the disinflation outlook. So what we're looking for in the next 6 months is really a phase of very low inflation or even disinflation tendencies around the globe. Coming to the first issue, weak economic growth, I think the best you can see that is when you look at the world trade. That's not particularly to one region, but this is really the sum of the global imports across all the countries. And you see, yes, we had an impressive recovery after this very deep recession in 2009, but since then, since this very nice rebound in 2010, world trade has actually leveled off at much lower levels, and lower levels than in the past decades. For example, in 2002, and 2007, but also in the decades before. We think to stimulate that, it will be very difficult, and we stick here to the view that this will persist for some time. Of course, this is a function of quite weak demand coming out of the advanced economies. And looking through what's going on in advanced economies, let me just show you, or starting with the US economic outlook, we think the economy is doing actually quite okay. The only problem is, and that's similar to the region I come from in Europe, it's basically fiscal restraint, so fiscal consolidation. And you see here on the left-hand side that without the government, actually, and this is the red line, GDP would have expanded, so the growth would have been much more brisk here in the US than with the fiscal constraint coming from the total GDP, which is the blue line. But we see also positive tendencies in the US. That's in particularly that the adjustment in the housing market is more or less behind us. You see that on the left-hand side, that really these crucial numbers like existing home sales, but also new home sales have turned the corner, and the worst is actually behind us. Further in the US, and this plays very much in the theme, why do we think that inflation is not coming back? Or why we even go further and say we might live in a disinflationary environment, is the quality of growth we're observing in the US. You might remember that in the times between 2002 and 2007, before the recession hit, the US had been the global demand factor for the world. US GDP growth was US consumption, basically. And this has changed. This has changed quite dramatically. And what I show you here is the share of private consumption, so end demand, really, in the US as percent of GDP. That's the green line. It's leveling off. And then I'll show you also equipment investment in the US as percent of GDP, which is basically a supply factor. For me as an economist, this is something I want to see. When the economy is recovering, you should first invest, you should earn your money, and then spend it. It's a much more sustainable recovery. From a demand side, this is also a much more sluggish recovery. So it's not the kind of recovery equity markets cheer about. And this is exactly the world we live in. We see in the US that's much more coming from business investment than end demand.
What is the horizontal scale?
It disappeared. I see it right now. Yeah, it's of course the timeline. Sorry about that. That's a technical issue. It starts at 2010 and goes until the current. So it's basically covering the recovery since 2009. I hope the others are there. Coming to Europe. So probably before coming to Europe, just one point I want to make. First of all, we see both in the US a sluggish recovery, which contributes to the one theme I tried to present you here, namely sluggish world economic demand. And the second issue, that even in the US we see some supply side issues. So it's more, you produce more, you rely growth much more on what you're producing than you're consuming. And of course you can imagine when you're producing more than you're consuming, then what prices do? Prices rather tend to fall than to rise. In Europe, when we look there at the demand situation and economic slack, how we call it, we look at basically two indicators. It's the easiest. It's first of all unemployment. So when unemployment is high, we tend to deduct that the demand side is very sluggish, that economic slack is quite present in Europe. And when you compare it internationally, that's on the right-hand side from your side, the unemployment rates, they have fallen across most of the economies. They have not fallen in Europe. So what does it mean, again, for this theme of supply-side shocks, or probably also for disinflationary environments? It means that when you have actually high unemployment rates, you tend to lower wages. And we see actually developments like that, in particularly in the crisis-hit economies, like, for example, Greece, like Portugal, but also Spain. Unit labor costs are falling, wages are falling. Of course, it's the only choice these countries have. You see as well on the left-hand side a more economic concept like the output gap. So that's a theoretical calculation here, really, what the economy can produce. And then we deduct from that what it actually does produce. And you see these negative bars here indicate that this underproduction, this underutilization of resources in Europe is particularly high. Also that point to rather disinflationary, sluggish growth. Big question is, of course, when we have this high unemployment rate, when we had now 2-3 years of Euro crisis, and of course, believe me, when I'm from Germany, I'm always asked that, is it over now, or do we need to prepare for more trouble to come? We think that the crisis we experience in the Eurozone is over. And this is not because Greece or Portugal has changed totally their economies. You know, when you look at newspapers and look for the causes of the Euro crisis, you find like numbers that in Italy, for example, they have 4 times more lawyers than in France. Same size economies, 4 times more lawyers. That in Greece, the people are helpless, inefficient. That in Portugal, they have too much debt. We think you have to step a bit away from that and really see the Euro crisis as a pure balance of payment crisis, which is a nice economic concept. In frank words, it means these countries have lived beyond their means. So what happens actually when you consume more than you produce? Well, your external balance goes into deficit. And when you're good, you can do this forever. When you find somebody who finances that. You can always judge and look at a country if this happens by looking simply by the current account balance. And that's what we have done here on the left-hand side. There had been current account balance crises before. So there had been countries living beyond their means before, and there had been finance also. The usual threshold when international investors stop finance these countries is around 6%, 8% of GDP. So look what happened in the Eurozone. Countries like Greece could finance their overconsumption much more than in an international context. And the reason for this development had been simply that people believed, not only investors, but politicians which set up the European Monetary Union, they believed a balance of payment crisis is not possible inside a currency union. And there is some truth in it. There are a number of transfer mechanisms that this financing goes on. But apparently, we experienced a balance of payment crisis because private investors withdraw their money out of Greece, withdraw their money out of Portugal, withdraw the money out of Spain. So where we are right now in this concept, and you see that we don't have current account deficits anymore. This is not a big achievement by these countries by saving. It's simply a natural consequence of the recession. So it's not that Greece is now exporting so many goods that they have a balanced trade balance or balanced current account. It's simply they don't import German tractors anymore. Okay? So it's a painful way, this adjustment. But I think for us here is important, where are we at this adjustment? And so far we think we are so far advanced in this adjustment that simply from this starting point, it's very unlikely that you see a balance of payment crisis inside the European Monetary Union. This does not mean that everything is great. I already outlined it. Underutilization is huge in the Eurozone. Unemployment rates are very high. Political tensions are there as they follow. But we deduct from that there will be some economic recovery. And when I go over to the right-hand side chart, that's the industrial production for the Eurozone. We see already some signs, okay? You see here the trend, particularly the 6-month trend, is turning actually up, that industrial production is coming back. And don't forget, even when you have long times of recession, the natural state of an economy is growth. Okay? After you have an adjustment, people tend to hold back consumption, they hold back investment, and it comes naturally back when this adjustment is through. We think large of the adjustment is through. Before coming to emerging market, just one view to Japan, what's going on there. Also the question, is probably Japan the new fast-growing economy going forward? On this slide, first of all, I have to say, excuse me, the other slide we had already at the timeline was missing here. Actually, the headline somehow was copied from the previous chart. I come to this chart later. But when we look at Japan, then this new policy introduced by Abe is actually quite successful in terms of lifting sentiment. What ask we ourselves, and particularly in the context of, will this sentiment translate in growth? Will this growth translate into inflation, and probably also then higher interest rates? We think that we are less optimistic. And you see on the right-hand side, this is the share of private and public credit in Japan. Okay? So what we see is actually that all this stimulative policy, also now the stimulative policy from the Bank of Japan, did not translate in that private takes out more credit. I mean, you have zero interest rate in Japan. You get the money for free. So the natural consequence would be to borrow more. But you don't. So private credit is actually still shrinking, and the only sector which takes advantage out of this zero interest rate is the public sector. We think this will not trigger a credit bubble like, when I understood it correctly, is happening in Israel with very low interest rates, with lots of money supply. And so we think the chances really that this policy of stimulating by money printing, for example, in Japan, will translate in a credit cycle, in a self-fulfilling credit cycle, are very low. And that's why we think also from this angle of the world that the inflationary risks, although this is a very reckless policy which has been done there, the inflationary risks are minimal. There are risks in Japan, in particular when we're talking about the fiscal situation, just highlighting here that it's more the income side, the revenue side, where Japan has a problem. It belongs, like the US, apparently is a country which has problems to raise revenues. And you might know they try already now to increase sales taxes. That's already in the law. But there's a big discussion to postpone it or don't do it all the way. So these are the advanced economies. Coming back to the emerging market economies, and I'll go back some slides because what I want to highlight first is political risks in the emerging market economies. We have seen it in the second eruption now in Egypt. We have seen protests in Turkey. We have seen protests in Brazil. And of course, we ask ourselves, is this something systematic? Do we expect more from this? And one angle to look at that is what happened with governance in the past 4 or 5 years. And for that, we use from the World Bank, the World Bank's governance indicator, and look at 3 groups here. One is the advanced economies, G7. The other picks we call basically the weak economies in the Eurozone, so the economies which had been under attack because of their weak governance, apparently, by investors. This is a perception. This is what you read in the newspaper. Greece is under attack because of weak governance. And then we have the emerging markets. And you see already at levels, yes, the governance in the PIGS countries, so in the weak Eurozone economies, has weakened considerably. But it's still far higher than in emerging markets. And just remember what interest rate spreads you was charged for Greek government bonds or for Portuguese government bonds, and what you received actually when you were holding Uganda bonds or something like that. Or I think the Mexican 100-year bonds, good for nothing. Why we think that driven from this weak governance, political risk will increase? Well, you would actually expect that when a country grows more wealthy, that governance improves. But this has not happened in the last 5 years. So first of all, governance has deteriorated in emerging markets. despite much more economic wealth. And combine that with a growing share of middle-class population. This middle-class population will demand more political rights, not less. They will not get away with that. And that's why we think from a political risk point of view, we will face actually more political risk going forward. Another issue coming to emerging markets, it's building imbalances. And I think the best example you can choose here is China. What we did here for China is basically to build up in private debt. And it's in percent of GDP. After the crisis had grown from 130% of GDP to 190% of GDP, or close to 200% of GDP. Not only is this a very high level in international comparison, I think Japan ended its miraculous growth in the 90s at a level of 220% of GDP. Ireland went into crisis at 220% of GDP private debt. So the level already is very high, we would say. But what's even worse is that in such a short time period, the debt has been built up. And I think without having detailed knowledge where this money is going, I think I'm right with the suspicion that not all this money, that not all this 11 trillion US dollars are going in the right investments. Okay? So it's the speed which has probably resulted in some misallocation of capital, but also the absolute level makes it very difficult for China here to grow going forward. The good news is here that the Chinese government so far has seen these developments and now trying to adjust these imbalances. And the good news is also that this debt, most of this debt, I would say like 95, 90, 96% is borrowed from Chinese people, so not from foreigners. So they have their time to adjust. But what we should see here, what will happen going forward, is that China will also contribute to quite weak demand. It will be not the same demand driver we have experienced in the past. And when you look at a global level, who is the biggest demand driver when it comes to gross investment, to gross fixed capital investment, then it's China. Okay, the volume of gross investment in China is larger than in the US, it's larger than in the Eurozone, and it's larger than in Japan. Yeah? So also on a global level, this has some implication. We think that in the emerging market context, China has a still quite comfortable situation because they borrowed everything from themselves. So from a crisis point of view, they're quite safe. But it will definitely, this situation will definitely contribute to quite sluggish economic growth. Looking at the other emerging markets, we took here the concept of imbalances a bit further. So we choose here to show you the balance of payment position, which is not only the current account balance I mentioned before for the European countries. So I said this is when you live beyond your means, but we add to that also the financing part of this deficit and the stable financing part. That's the foreign direct investment. Usually when you're an emerging market country, you don't need to worry when you have a balance of payment deficit, when this is covered by direct investment. Take an example, for example, when you build a big factory, you have large, by a foreigner, you have large foreign direct investments, but you have also large imports because you need to import probably the machinery from the advanced economies. So this balances then usually out. The problem for emerging market is rather they are more a victim of their past success. Just imagine you are a country growing 10 years above the rates of advanced economies, and that's been the case for most of these economies, then you start to import more and more. And that's not only machinery for the foreign direct investment, but you start to import also the knife fix, the consumption goods. And when we look at the balance of payment position, you see that a number of countries not only have deficits, but we put here also the year change, that the dynamic is for most of the countries negative. So going more and more in the deficit situation. Actually, the notable exception is here the small Eastern European countries. And why is that so? Well, for example, Hungary, they had just 2 years ago their balance of payment crisis. This is a distinguishing part here really for Czech Republic, for Poland, but also for most for Hungary, which had its balance of payment crisis. In the others, we see actually that this is in the making, and this is a risk going forward. The result, we've seen it already in the past few years. Inflation is falling across the board, basically. I put here several aggregates of inflation. It's falling for emerging markets, but also for the advanced economies, and we think this trend will continue going forward. Going a step further, and particularly approaching here the investment implications is, well, inflation is falling, so what, you would say? What is then, how can I profit from that as investor? And you can profit from that by a very loose monetary policy. And what we made here is actually counting all the central banks which are hiking rates and balancing this with all the central banks which are cutting rates over a 3-month period. And you see that we are still in a situation where monetary policy gets looser and looser, where interest rates had been predominantly cuts. I think the only exceptions had been Brazil and Indonesia, which already now need to defend their currencies. But the dominance here of rate cuts is still there, and this is, of course, a positive development for investing in risky assets going forward. We have here stimulative monetary policy, and just putting aside like all this debate about tapering, we think, looking for the next 6-12 months, with this inflation environment, we can be quite relaxed that interest rate hikes are far, far in the future. So all these fears of that this monetary policy would be too stimulative, that we see a return of inflation, we think are overdone, and particularly looking at this investment horizon for 6, for 12, and even for 18 months. Skip the details for the central bank details. I think you might be more interested in the implications, or some implications, for different asset classes. And I think these three themes can be nicely translated in three investment themes. The first one is the sluggish growth concept. And for that, we looked what sluggish growth means for different asset classes. And just as a guidance here, we used US industrial production. We put it in different buckets. So here so contracting industrial production or contracting growth, then 0 to -2, 2 to 0 to 2, and then really the stronger growing environment. And what we see that in an environment of rather sluggish growth, so 0 to 4%, we should see not only equities being a good investment, but also high-yield corporate bonds, in particularly the high-yield segment, because the growth is high enough, basically, that default rates are falling. That usually is enough. You lose, actually, when you go in a more quality bond space, more quality papers in corporate bonds, you lose actually also in this area, similar to government bonds, you lose out on a relative basis because these names, of course, participate then also for apparent rate hiking expectations. So,
what is the database for these graphs?
Well, we use one US industrial production, and the other one is US assets here. So US high yields bonds, US government bonds, and US equities.
Time scale, because it's not only the growth, it is also the yield that it was in the same period of time.
For how long we use this?
For how long? What was the economic?
We use it for a very long. That's why we refer to the US. So we used it, I think, since the 70s, because we wanted to be across economic cycles. Yeah? So it's monthly data, obviously, when you have industrial production. And we wanted to have a very long time period in order to cover fully all of these buckets, basically, of recession, of stagnation, but also of very high growth. That's why we used US data.
We have to take into account also the inflation and the monetary policy and things like this.
Well, that's the returns you earn when you invest there.
I see. Okay.
And here I have to excuse also the headline is on the wrong. It's from the previous chart. What we think and what underlines basically why we think you can stay in equities, it's not only that equities are performing also quite nice basically in a growth context. So we're saying basically recovery continues, it recovers sluggishly. But what encourages us also to take the investment stance pro equities, so risk on, is basically that the fundamental situation of companies is very good. And this is basically here the the fundamental situation of companies. First of all, the indebtedness, which is low and falling. This is the red line you see here. And then even free cash flow, so the money company actually earns, is still at very high levels. We think we have reached at the top, so really the nice returns you made on equities in the past 2 years will probably level off based on that. The best is over also for fundamentals. But we are still some time away before companies start to spend money for, let's say, stupid things and really start to be more indebted going forward. So we think the balance, the fundamental situation for companies is much better than, for example, for most of governments. For emerging markets, probably that's not difficult. When we see political risks rising in emerging markets, when we see at the same time quite some imbalances in emerging markets, then the conclusion is obvious. We recommend right now to avoid emerging market assets. Despite the correction we have seen there, we think we are not yet there that these imbalances have wound off. Just the contrary, we think we are just at the beginning that these imbalances are being wound off. I think it's right to distinguish here what emerging market we are talking to. So particularly hard hit are countries like, for example, Brazil, but also India in terms of imbalances. I said already that in China, these imbalances are mostly internally, and given the strong governance there to manage really these imbalances, we think the unwinding will be more smooth than in other economies. You see here,
Excuse me?
yes,
In China, the situation is better than in Brazil and India?
pardon?
You suggest that in China, the situation is better than in Brazil and India?
Yeah, the situation is, wouldn't say better because this would be in judgment, but I would say for an investor, it's more healthy. Okay, and let me explain. I mean, I outlined the governance in China is as poor as in Russia, Brazil, or India. Okay, from these indicators I showed you. The middle class is also growing, but I think the grip of the government is stronger than in Brazil. So these protests we have seen in Brazil, for example, this will take some time until they happen in China. That's one factor. And the other factor, from an investment perspective, from an investor perspective, China is not exposed to foreigners lending to China. So they can't withdraw the money and bring this country to a crisis. This is in particularly important when we're looking at these investments. We look at in China, it's mostly fixed income part we look at, where we are exposed to the currency. We are not afraid of the currency. We are afraid of the Brazilian real. We are not afraid of the Chinese currency. And we are not afraid so much on the interest rate levels exposures there. Okay? So politically, I wouldn't make a judgment here, but I think from an investment perspective, you can find still some nice opportunities in China. This is much more difficult in Brazil. Okay. Yes?
China will split to two, maximum 5 countries, will split. China will disappear like a state and will emerge other countries in 5 years from now?
Yeah, I understand your question. Well, I'm not a full-time China expert, but what I know from the political setup in China, it's that it's for the government very important to have the outer regions around main China to protect them. So it's a military angle, basically, which will probably prevent that. I mean, living through the euro crisis in the last 3 years, I don't exclude anything anymore. Okay, but I think it's rather unlikely that really public unrest will rise there. I mean, the preconditions are in this respect there, that there is a very wealthy middle class growing. But this middle class is growing rather on the coastal regions. So this would be actually the areas where we can imagine public unrest. The regions inside China, they are rather the poor regions, which are still supported by the central government in terms of money transfers, in terms of infrastructure built up and so forth. And this creates dependencies, which is probably in the interest then also of the central government. So I think it's unlikely. But coming back to emerging markets, so when we have the macro setup and the political risk going on, and we combine that actually how much money was flowing into emerging markets, and we use that as a rough indicator here, using basically the market value of this different corporate bond indicators here, using here in particular the corporate emerging market bond index. It has grown 5 times actually in the last 5 years. So it's basically so much money has been flowing in this country. The fundamentals are deteriorating, so it looks more like a perfect victim going forward. And when we look at other areas or other asset classes, for example, equities, when we look at reported earnings, they are growing nicely in the US, but they are not growing in emerging markets. So also profitability is already hit apparently by this growing imbalances, and this confirms our stance here. I promised you, I think, a last point, and these slides are rather annex when you ask some questions. Coming to the last investment conclusion, and that very much relates to this environment of disinflation and loose monetary policy for longer, we think this will, of course, support risk appetite going forward. We are now in the summer months, since this tapering debate, bit here, risk appetite had been reduced a bit, but we think, particularly for the rather longer time period, because of monetary policy will stay loose and will probably stay looser than many at the marketplace expects. We think that risk appetite will come back finally, and this will support, in addition, in particularly risky assets. Okay, in particularly equities can or have then the potential to grow more than earnings are growing. So investors are basically prepared to pay more multiples here for equities. We think this environment of very loose monetary policy, and in particular the underlying cause, basically low growth with a disinflationary tilt, is here the important driver, which will persist for quite some time. Coming finally to currencies, and just a word on the euro going forward. We had actually always thought that the euro has no problems versus the US dollar. We then, at the beginning of this month, adjusted here this view slightly. And this is not because, as I said, we don't expect that the euro crisis is returning, but we're seeing that actually this conservatism of the central bank is being slightly eroded. And this made us a bit more worrying about the euro exchange rate, so we took this exchange rate down. and have here adjusted our forecast. And we see also that interest rates are going in different directions. In the US, the central bank is more than happy that interest rates, in particular the long end, are crawling up slightly. For Europe's situation, this is totally inappropriate, and we think this spread in interest rates, that interest rates will be higher in the US and probably even falling in the Eurozone, will continue and will weigh in the euro, on the euro exchange rate. Finally, on emerging market currencies. Yes, please.
In the previous chart,
Yeah.
there was a forecast from Goldman Sachs saying that the euro is going towards $1 in a few years. What do you think about this?
In few years? Well, I think in a few years the business cycle of the Eurozone and the US will align again. Okay, we don't think that the US will grow much faster. And you know, for a sharp devaluation of a currency, what we would like to see is first very high inflation in this area. So for example, in Brazil, you have very high inflation. This is unnoticed by the currency, and then comes the drop. In Indonesia, you have very high inflation, and then comes the drop. In Russia, and so on. We don't see this in Europe. Despite that the ECB have shifted here a bit to more forward guidance, we think they are still conservative enough that they stick to 2% inflation. So inflation outlook is more or less the same. The second thing is that the Europeans are not dependent on foreign capital flows. They have surpluses in their current account. They are an export region. Okay? So they are not in a situation where where foreigners withdraw money and drive the currency down. So it will be very difficult to drive this currency down, or probably don't know what Goldman Sachs has as an underlying scenario, or you will need actually very, very severe risks being priced in the euro exchange rate.
But as you said, the interest rates are plummeting in the States, and they are probably will stay low in Europe.
Yeah.
What are the implications?
Yeah, I think this is an implication for the next 3-6 months, but not for the next few years. I said already that the business cycle for the next few years, when we're talking about 2 years, 3 years, the business cycle in Europe and the US will align again, and then interest rates will align as well. You know, this is very unusual that, for example, really treasuries and bonds, like the major benchmark rates, are drifting apart. You need to do quite lots of work to make them drift apart. Okay? Usually the correlation is very tight between US government bonds and German government bonds. We have now a unique situation where the central banks are working in very opposite direction. I think this will be passed in the next 6 months.
What do you think will be the lowest mark for
For?
euro? Euro?
For the euro? Well, we have the 3 months forecast of 127, but I can imagine also 125, 124. Yeah. Not below that, no. There is also here with the, the US dollar being a very strong currency in the past 3-6 months, we have seen it had been strong against the Australian dollar, it had been strong against the Brazilian dollar, it had been strong against the Canadian dollar, against nearly everything, not against the euro. Yeah? And one major reason, and that has been a theme we were pushing for quite some time, was that we thought that the ECB is much more conservative than other central banks. Mostly because of their mandate, not because it's different people which are sitting there. Most because of their very tight mandate. And we have to frankly say we were a bit surprised by the last press conference, where some of this conservatism has been given away by giving forward guidance, and that's why we adjusted this forecast. When you ask me how far they can go, which giving away price stability, conservatism, I think there are certain limits, and particularly when it comes to the legal framework they're operating in. It's not the people. Okay. Just the last word on emerging markets. When you are interested, we see also, or in particular here on the currency area, this theme of current account imbalances or current account deficits. as a major driver. And we put here actually the basic balance. So this is exactly the current account plus the foreign direct investment. So the balance of payment position that's here on the vertical axis, and then some valuation measure here. And of course, countries which have deficits in their balance of payment position and are expensive, they're actually quite prone to adjustments. And I put here also what happened in the last 3 months with these currencies. So this light dots here are actually what has been the status quo 3 months ago. And you see Brazil had been here hit, Mexico had been here hit, but also Russia and also Turkey, all currencies which had been here under pressure, both in terms of valuation, but also in terms of balance of payment position. Skip the next few slides because I need to come to the end. That's the last 3 slides. That's the expanding role of Julius Baer. Now we have 3 slides of disclaimer. And I thank you for your attention.